is Pat asked in the community, we use FOViv up for put credit spread stress testing. What do we do for call credit spreads? So I want you to get into the idea of thinking in terms of FOViv as just getting an idea of the high price and the low price. Okay, so if we go here and I go to SPY, I'm going to go to Wednesday's options just because. And I'm just going to use Don's method and go down to the minus 10 delta right here, 273, 270. Be a 3-point wide spread. And that gives me the FOB value of 3 cents. So 3 cents is the fair price based on this price distribution right here. This is the default. And so this is looking over the past 4 years at the price action of the S&P 500 and saying that based on the actual distribution, this is the fair price. This FOB is the fair price, and it should be 3 cents. It should be 3 cents based on that. It's taking everything in there into consideration, sampling those time periods, and getting it done. When I click on FOViv up, first I got to click on FOViv, get rid of some of these. I can see the column headers. Wait a second for the system to catch up to me. There we go. So the current price of this is 56 cents. When volatility is higher, I'm getting a price of $2.19 on this. This one's 34 cents. When volatility is higher, I'm getting a fair price of $1.60. So if I was to do this trade, I'd be looking at about 20 cents here, right? 20 cents above 2, and then about 40 cents down here. So I'm looking at about 49 cents is the size of this credit if the implied volatility was higher. If the implied volatility was lower than it is right now, these are both 0. These are both 0. So at the low price, this is worthless, which is what we're hoping, right? When we're using a selling strategy, we want it to be worthless. And if volatility goes lower than it is right now, that's what we'll get. That's what we're expecting, is to be worth 0. But if volatility goes up from here and goes higher, the fair price when volatility is higher than it is right now is 49 cents. We're only getting 22 right now. So the way that I look at FOViv up is it's telling me what the high price is when it's FOViv up. That's giving me the high price. And this is just good information to know when you're going to go buy and sell something. You want to know what the price is. You want to know what the high price is. You want to know whether you're getting a good deal, right? And so if you're selling this credit spread for 49 cents, you know that that's a high price. If we're going at the market price right now, or at the ask price on Friday's close, we'd be getting 22 cents, about half that. And if we were looking at implied volatility below, it's worthless. So depending on the strategy that you're using, so if I was to do a call credit spread, I'm going to go up here and go to the delta of 10. So the closest one to 10 is this one right here. Now it gives me 30 cents. I'll go up. Couple, 3. And so I can look at the same thing, right? So I got FOViv up and FOViv down. If volatility is higher, this should be higher. volatility was lower, this should be lower. So that's kind of interesting. But if I was doing a call credit spread, I would do the same thing I was doing for any, so evaluating any option strategy. If I was evaluating the iron condor, this is the iron condor down here, because if I take the put out, I'm not getting 42 cents, I'm getting 20. So I'm only getting 20 cents, not 42. And FOV is 8. So FOViv up gives you the high price, FOViv down gives you the low price. And your stress testing depends on what your strategy is, what your focus is. I'm going to use the FOViv no matter what strategy I'm using, but it's what my strategy does and what I want that's going to make the difference in how I look at it or how I evaluate it. So it's not the bullishness or bearishness of the trade. It's just evaluating the price. It's just a way to evaluate the price of the option when it's higher and when it's lower. And so the stress test is, in the worst case scenario, I don't want, if I'm doing a credit spread of any kind of credit spread, if I'm selling options, I don't want that price to go higher. I want it to go lower. So to stress test it, I'm finding out what the high price is so that I get an idea of what to expect, and figuring out if I'm in the right price range. Is 20 cents enough? Is 20 cents enough? Well, in the worst case scenario, it should be priced at 79 cents. So 20 cents probably isn't enough. It probably isn't enough. On the low side, 4 cents is what it should be. And if volatility is going to go down, that works in my favor. That's good. But what am I expecting volatility to do? We think it's going to go to the average. So we're leaning that it's going to go more towards here, but we want to be cautious because we know it can go out to here. It can go out to this price, to be fair. So we're using it to evaluate high, low prices and figure out what is the price that's acceptable to us based on the probability of the trade. We get that by clicking on this. We can see, in this case, that probability is 83.55%. So it's just a high and a low price. You're stress testing because it would be stressful if these option prices increased in value after I sold them, after I'm a net seller. If I'm buying options, I would stress test down, the FOViv down. That's how I would stress test. Worst case scenario, what is this option worth? If I'm buying it, could I get it cheaper? That's what you're asking. And if I was to switch positions here and buy this as a debit spread, instead, my debit would be 22 cents. And if I'm stress testing this and saying, oh, it could actually go down to 4 cents. Am I getting this cheap enough? And what's my probability of success? And with this, it'll come up, it's going to be the exact opposite of 83. It's going to be 16. 16% chance. So am I getting that cheap enough? Probably not. These options are a bit expensive. They're pretty expensive. So that's how you stress test any strategy. Is what do you want to have happen? What's the high price? What's the low price? And you can kind of figure out from there.